Great. Well, welcome to our March 20th coffee talk. And again, just want to welcome Tera with AGI3, and they have a really innovative insurance platform and program to use, along with an ancillary contract insurance program that's going to be launching a little later on this month. And if you don't mind, Tera, just give a brief background about AGI3 and your role in it, and then I'll just turn it over to you just run it as you see it.
Yep, absolutely. Thanks, Dean.
Yep.
So AGI3 itself is it's a newer company. So this is going to be our third growing season with offering coverages to farms. It is a production-based coverage. So it's not a revenue base. We're quite similar to the crop insurance program, actually. So if you're familiar with that, it's not going to, take a lot for you to catch on to how AGI3 works. For myself, I have been in the private farm insurance space for the last 12 years, working with farms throughout Alberta and Saskatchewan mainly. And so I was with actually Global Ag Risk for a good decade there as well. So yeah, I know quite a few of those programs in and out, like the crop insurance program, Agri Stability, now AGI3 and GARS. So yeah, I've been helping farms make their decisions here with their insurances for quite some time. So what I'll do, I'm going to share my screen and we can get into the program here and give you guys an overview. Okay.
You're good.
Good? Okay. And if anyone has questions as I'm going along, just feel free to jump in, okay? Here we go. Just make sure my mouse is working here. Okay, so what I'll go through here is like who we are, how we're backed. That's important. Why AGI3, our core offerings, how it works, and then I'll give you like that 30,000 foot view on our Forward Protect, which is a new coverage that's going to be launching here. Dean had mentioned end of the month. So we'll have a little bit of information on that. And then I'll take some questions too, like I said, as we go along, or you can wait till the end, absolutely. So starting with our founders and sort of where we came from. So Dr. Lisa Porth, her expertise is in actuarial science, and she did quite a bit of work with crop insurance, the provincial crop insurance program. So she brings quite a bit of knowledge forward with that. And then Ray Bouchard, some of you may know who he is. Enns Brothers might ring a bell for Manitoba there. So the JD dealerships in Manitoba. So Ray is also behind AGI3. So lots of experience behind it. Our core team. So this is the core team here. We are a very small team. And I feel like as we keep getting bigger and bigger, like with the amount of farms that are inquiring, it's quite busy this time of year, especially pressing on that crop insurance deadline. So for myself and John DeVos, I would say we are more face forward dealing with a lot of the farms. Mark Emerson, he's in the background quite a bit. He does deal with some farms too, but he's mainly like our tech guy on the platform, and Kyle as well. So he oversees everything. He's working on a lot of special projects like the Forward Protect and things like that. So again, very small team. We are 100% Canadian. So that was the Face Forward team that I just showed you, the four of us there, but really there's a lot of people in the background and we're all spread right across Canada. So from our head office in Winnipeg, and we have our data engineering, business development, our actuarial team, we're all just spread across Canada here. So we're quite proud of that, being a Canadian company. And then further to that, our strategic partners, so how we are backed. Some of you may have heard of Definity Economical Insurance. They're very strong in the P&C space. So that's like your farm property policies, like your machinery and all that kind of stuff. So they're our backer, and they're also a Canadian company. So there's billions of dollars that are backing our program. So basically, like one of the main questions I get is if I purchase a policy, you know, is that policy good? Is it safe? Am I going to get paid in a claim position? The answer is yes. So as soon as a policy is purchased, those liability dollars are full on set aside in case of a claim position. Okay. So our platform itself, just having a bit of a lag here. So our platform, like what we do is we end up building out your farm and mapping you out. Okay, so once you're mapped out what you're seeding, where you're seeding it, so we'll get the LLDs and all that, that is how your farm is priced. So it's priced on where you're farming and what you're seeding. Okay, so everybody has unique pricing built in. So everybody would also have access to this if you would want to go into your account and you can sort of maneuver around and take a look at your pricing. You can also map out your farm on your own. We do most of the loading as well, but it's a very interactive, easy to use platform. So our core offerings through Ag i3, we call it our Agra Enhance. Okay, so there's three core offerings. So individual crop, which is your crop to crop type coverage. You can pick and choose what crops you'd want coverage on at what levels. And then we also have co-insurance, which is unique to us as well. So co-insurance is like a layer of coverage. Essentially, if you don't need that full bushel for bushel straight on coverage, there's a way that you can buddy up some additional coverage to your existing crop insurance plan and just enhance your coverage there as well, and with some premium savings. For any of you that have taken the SCIC CAP program, so the crop averaging program, that is fairly similar to our whole farm. So the crops that are eligible for coverage would get bundled together and crop averaged, and there is a diversification discount for our whole farm product as well. So how I view the core offerings here too with Ag i3, it's not to replace what you're currently doing. Like, we're not looking to replace the provincial crop insurance program by any means. So with the, rise in costs and, now you're throwing in tariffs and all kinds of things, like every year just seems like it's completely different to the next. And more farms have been seeking out additional coverages. So that's sort of the viewpoint that I look at it from, is how do we enhance what you're already doing? If you're going to be spending a premium, where's the best place to be spending that, right? And like, what is your plan? Are you expanding and need some additional coverage? Are you purchasing new equipment, et cetera? Or maybe your crop insurance isn't quite as strong and you want to buffer that a little bit. So those are just some different angles that you can utilize the program with. So to break it down a little bit further, we operate on what's called an indemnity band type of coverage. Okay, and we have 3 different coverage levels to choose from. So if we were to start, with 100% expected yield, we need to determine that. What is that 100%? So we would trigger at 80%, 75, or 70% of that expected yield. And then we would have those indemnity bands as well. So as an example, if you wanted to take coverage on your canola at the 80% and took a 150 band, if you were in a claim position below that 80%, and now we're paying you, the max that we would pay would be $150 an acre. So we know with crop insurance, they'll pay all the way down to 0 if you were to grow nothing. So with Ag i3, and this is where I say, like, we're buffering and offering additional coverage to kind of overlap that. So we're hovering kind of in that top risk area. Okay, so at that 80% down to 70 essentially. So there's different options there. And we have different crops that are, go ahead, Dean, yeah.
Yeah, so just in terms of, can you just explain how you arrive at the average yield?
Yeah.
As to what ifs or whatever you're using with crop insurance? Yeah.
Yeah, absolutely. So as of right now, we're starting with what is your 2025 what if statement, and that will show what your 100% expected yield is with crop insurance. Now, there are some differences with crop insurance and Ag 3. So as one quick example, 2024 yields, there's a lag year with crop insurance. So that's not included into the average with the expected yields. So this isn't, this is kind of the exception more so than the rule, but sometimes what'll happen with incorporating the 2024 yields, our expected yields can be, a bushel or so lower sometimes, but more often than not, we're utilizing the 100% crop insurance yield. So that's our starting point. So with some of the information that we will need, and I do have a slide on this too that I can put up, but we would require as well, like your yield history, okay, so that we can also see that, okay? And yeah, so did that answer your question, Dean? Good, okay.
You bet.
So we have some different crops covered right now. And again, with Ag 3 being a new company, as we are gaining more information and data on additional crops, we're going to be adding more. So like I've had quite a few requests for canary seed as an example, and mustard. So I can see those ones are going to be coming in the future. They're not available this year. We have a very small pilot this year that we are launching on chickpeas. So there's certain areas that we're going to be offering some chickpea coverage, which I don't have listed here, as again, it's a small pilot and we'll have some limited capacity there, but we are growing our insured crop list. Okay. Okay, so I'm going to just dive into some of our coverages here just to show you some of those differences. We do have, like I said, co-insurance. So it's a layer of coverage that you can have and utilize if you want to buffer your SCIC a little bit. So with that, co-insurance, there are 4 options to choose from that you can see here on the chart. They're all available at the 80% trigger point only, okay? And available at the 150 band level. So there's a reason that it's offered on the 150 band only. And that reason is because on the far left, you can see that it's broken out into the first $50, the middle 50, and the last 50 of that 150 band. I will draw this out for you in a slide coming up too. So this is just a quick overview before we get into that. But as an example, if we look at option number 2, if we're in a claim position below that 80%, so now we're in a production loss and we're triggering a claim. And if you were to take option 2, the first $50 of that $150 band, you would be receiving 30 cents on the dollar for every dollar in claim. Okay, so that's what you would be receiving. And then if we were to fall further into a claim position and now hitting that middle $50 on that 150 band, you'd get 50 cents on the dollar, the last 50, 70 cents on the dollar. So now we've effectively taken that $150 band with that option 2, your max payable, if we were to max out that band, would be $75 an acre. Okay, so with that, premiums are also reflective of that, right? So if we are giving up a little bit of coverage, your premium is also going to be quite a bit less. Okay, so that was option 2. You can see option 3 is a lot more straightforward. It's just a straight 50 cents on the dollar for every dollar in claim. So if we owed you, that $150 in that claim position, your max payable would be $75 an acre as well. Okay, just a different way to look at it and structure it. So there are a few different options there. We do have on our whole farm, we do have one co-insurance option available, and that is that option 3, the straight 50%. And that's actually been a really popular option this year. So farms are still taking, their full SCIC coverage at their 80%, and then they're buffering with a whole farm type of a crop average coverage through us at that 50% co-insurance. So their premiums essentially in half. So that has actually been a really good option just to add that little bit of extra coverage. Okay, so in this slide here, I'm going to go over a visual representation and tie these coverages all together for you guys, just to show you how they work and what that band actually looks like. So I have a really basic crop plan here. So durum, barley, canola. We have expected yield. So again, think of like your crop insurance 100% expected yields. and the probable prices. So in a claim position, we will also be using, whichever province you're in, we'll be using the provincial crop insurance prices in a claim position, okay? And at this point in time, we don't have the contract price option quite available yet. I can see that be something in the future that we also might look at and bring in as well. It seems to be a pretty popular option with some farms. And then the other thing too, before I move forward, I just want to touch on the grade factor as well. So like with crop insurance, like they'll cover grade. We're not quite there yet with grade. So for us, it's bushels in the bin at the end of the growing season. And again, and that's why I don't look at it as a full-on replacement. It's what are your needs and what are you looking at? So, okay, moving along then. So in the green box up top, I have the yield times price. So that's essentially the 100%. I'm taking the expected yields and timesing it by that base price and getting that yield times price. We'll call it a revenue, but it's still technically a production-based product, okay? And then I'm going to be illustrating for you the band size of $150 an acre and the coverage level of 80%. So that's the trigger point. So in blue on the far right, I have our bushel triggers. So that's the 80% of that 100% expected yield. So where we'd be triggering. So let's start with individual crop. I'm going to layer in the 100%. The 100% crop insurance yields essentially, okay? So we have that per crop, the durum barley canola, and we're gonna layer in the Ag I3 band. So that's again, starting at that 80% trigger point per crop, okay? So you can see where that band would start. So where we would be triggering right here. And if we're in a claim position, moving down where that exhaust trigger would be and where we would stop paying. So again, crop insurance will pay all the way down to zero. So with us, this can also be a really good stacking opportunity too, especially when you're intermingling with agri-stability as an example, because there's some really good synergies with private insurance and the agri-stability program. And I'll touch on that a little bit too. So with co-insurance, I'll move into that one. Works exactly the same as the individual crop coverage. So just think of that. The only difference is what you're being paid out in a claim position. So I'm going to layer in those $150 bands again, crop to crop. And we'll start with the barley here. So with the barley, that's that option 3 that I had illustrated on that co-insurance chart. That's that 50 cents on the dollar for every dollar in claim. And again, premiums are reflective of that. Okay, so if we're triggering there, like I said, it's still triggering at the exact same position as that full bushel for bushel coverage on the individual crop. It's just what you're getting paid out in that claim position. So it's quite simplified. Now on the canola, this is that option 2 that I had highlighted on the co-insurance chart, where we're breaking out that $150 band into the 3 $50 increments. So if we were to fall into a claim position just below that 80%, so your first $50 in claim, you're getting 30 cents on the dollar. If we fall further into a claim position, you know, you're receiving that 50 cents on the dollar for that middle $50. And your third 50 is 70 cents on the dollar. So this one's even though it's the same outcome as essentially on the barley, it's a max $75 an acre payout. It's progressive. Okay, so as we fall deeper into a claim position, you're getting more on the dollar for every dollar in claim. So it just sort of depends how you want to stack it. The premiums are slightly different between those two options as well. Just depends on your needs. And the reason why I illustrated it like this too and left the durum as the full 150 band, because you can intermingle these. If you were to choose, you know, that on the barley, that straight 50 cents on the dollar, you can absolutely do that. And you can take a different, you know, coverage on the canola, different trigger points, etc. So it's very, very tailored and customizable just depending on your needs. Whole farm. So again, if you're familiar with the CAP program, crop averaging, it's very similar. So eligible crops get crop averaged all together. And it's just a straight band across the farm, a straight band of coverage. Okay, so that one's very simplified. And again, there is a 50% co-insurance option available on the whole farm, just like how it's illustrated there on the barley. Okay, so that, again, that's has been a very popular option this year for some farms. Any questions on this?
I've got one to start with, relating to the last one, the whole farm. So what would the premium spread be between the individual crop selection versus doing a whole farm aggregate average of hitting 80% of each commodity?
Yeah, so on average, with the whole farm, when you're crop averaging and diversifying, like you're essentially reducing the risk for the insurer, right? So there is about a 10 to 15% discount on average for the whole farm as well. And then further to that, again, with the co-insurance, now you're splitting that in half even further if you wanted to do the co-insurance option on the whole farm. But yeah, the savings are there for sure.
Thank you. Yeah. Any other questions for Tera before she moves on? And again, one thing too, like some of you might noodle through it and come back after. I know Tera will be more than happy to have a one-on-one with anybody about visiting, just for clarity in that. And then this is being recorded and it'll be on our website and our YouTube channel as well for review if you guys want after the fact.
Okay, so I had mentioned synergies with agri-stability. Some of you may already know this. So with a private coverage, if it's a claim year and say AgI3 is paying you now, we're in a claim position and you have agri-stability, our claim payment is not used as revenue in the agri-stability program. So it's not offsetting your potential benefit through agri-stability. So agri-stability is a very, very inexpensive federal program. If you're not in it and you're looking at, private coverage, it might be a good option to review and take a look at and just see what that reference margin might be for the agri-stability program for you. So again, very inexpensive program. I don't look at agri-stability as a really, really solid planning tool because it always comes later. So if it is a claim position, typically agri-stability, like you have to go through the accounting process and filing process with them. And it comes on average, like about a year later, you'd receive your payment. So I don't look at agri-stability as like a cash flow type planning tool. It's sort of like a bonus. But if you can, again, enhance a very inexpensive government program, why not? So I've seen some massive differences with being able to, enhance that AgStat program as well. So there's been some really good outcomes with some farms by just structuring their coverages a little bit differently. So that's a production year claim. We know the claim payment isn't, used as revenue in a claim scenario. But what's kind of neat as well, further to that, is when you're looking at your reference margin and that's being calculated for the next year after the claim, what ends up happening is agri-stability will then use the claim payment as revenue to keep the farm revenue up so that it doesn't look like there's any missing revenue on the farm. So then your reference margin is not negatively affected. So it's sort of a double bonus there. And then the third thing, which most of you probably know, in 2023, agri-stability changed its compensation rate. So if you were receiving a benefit from them, so that the compensation rate went from 70 cents on the dollar to 80 cents. So that has also made quite a big difference. So again, I just want to highlight this and just kind of give that 30,000 foot view on AgStat. Just there's a lot of, negative, I would say, comments that I receive on the AgStat program, but really when you kind of dive into it, it can really be utilized as part of the farm plan. Okay, so we'll go through our timelines. So as of right now, like we know we're kind of getting to the end of the month for on the Sask side for making decisions with crop insurance. So right now we're quite busy doing like the pricing and whatnot for farms and doing those reviews. By April 30th, that is our purchase deadline. So that at that time, 50% of premium would be due. During our growing season, June 25th is when we would need to receive your seeding report. And we can just utilize your SCIC seeding report, so you don't need to be duplicating multiple reports. So we can utilize that. And that's when we would true up or true down based on your actual seeded acres, what that final premium would be. And then by July 15th, that's when the remaining balance of that premium would be due. We also will be looking at, we'll call it a crop health check update before your harvest, okay? So somewhere around the beginning to mid-August there, we'll be asking for that information. How are things looking in the field at this point in time? Are there any issues? If it might look like a claim position, we'll work a lot closer with you on that. And then we'll also ask for a stored grain report as well, just to know what you currently have on farm before you start harvesting. By November 15th, that is the absolute deadline for the harvest report. And then that, again, that's going to enable our claim registration. So we're going to know at that time, like if we're looking at a claim position or not. We pay out our claims quite quick. So if you're, finished harvest at the very end of September kind of thing, like get that harvest report in right away, because we can start working on the file right away as well. Okay, so to receive pricing for your farm, it's very, very basic information that we need. Just your contact information, your farm name if you have one, your 2025 crop plan. So that would include your field names, your acres, what commodities you're seeding associated to those fields, and the LLDs. So again, we map out the full farm. And then best combination. So we also like to gather that up to 10-year historical yield data as well. So that helps with our underwriting. Your most recent provincial crop insurance coverage. So that would be your 2025 what if statement. And also if you use or have shape files, so we can also implement that into our program and map out your farm by using the shape files. So it's very simple information that you would need to send over just in order to get started. Our turnaround time for receiving the pricing is fairly quick as well. Okay, so before I move into Forward Protect and kind of give you that overview on how the contract coverage works, does anyone have any questions on the Agri-Enhance?
So for folks that just want to test the waters, what's your kind of turnaround time for you have the right information and getting back to them?
Yeah, it's just as simple as us loading the information. So if it's sent over, we'll usually have that loaded within a day or two. I guess it just depends on how many we have, in the queue, right? But typically it's pretty quick that we get it loaded, and then we can book an appointment and run through the platform with you. And then we'll give full access to the platform as well, so that you can go in on your own and take a look at your pricing and your farm map and all that. Yeah, so the turnaround time is pretty quick.
Okay, and this may be putting you too much on the spot, and just whatever with that answer, whatever you're going to answer, Tara, but do you have zones and any examples of what a premium could be? Like we've got folks on from Prince Albert West East zone, we got folks over in the dry belt west of Kindersley on the phone, and that Yorkton over to Watson zone and stuff. Do you have any examples of what things might look like?
So like our sorry, go ahead if you want to finish.
I know this is in pencil. It's just like it's not written in stone here, but every farm is priced, separate from the next. So again, it's sort of based on where you're farming. So that's why we need those LLDs and fields and that kind of thing, and what commodity you're seeding, and the historicals and all kinds of things. So there's wildly different premiums from farm to farm, area to area. So like my area, like where I kind of come from, is Leader Sask area. So, in the past few years, we've seen a lot of single digit yields as an example. So the premiums around Leader are going to be quite a bit higher
than, you know, like a northeast Sask farm, right? Where you're in a stronger soil zone and don't have as much of that, you know, that yield volatility. So it can be quite different. I don't want to throw out numbers but like it can be wildly different. But again, this is where I take the perspective of, if you're going to be paying a premium, what makes the most sense, right? Like, we don't want you just willy-nilly spending premiums and it not making sense for your operation. It has to be stacked properly and be an actual plan for you. So it does have to make sense overall.
Sure. Okay. Well, we'll leave it at that. That again, I guess just the best thing would be to submit and get your own.
That would be the best way to do it. And especially with the turnaround time and being able to have access to your online account, like we can have pricing to you right away.
Yeah. Okay.
So,
thanks for that.
Okay. So on Forward Protect, this is a new contract coverage that has been in the works here for the past year with us. So we're hoping to launch that here at the end of the month. We're just kind of getting the platform and that kind of thing ready. I might not be able to, if there's questions on this, I might be limited to how I can answer some of those questions just as we fine tune the program and launch it, but feel free to ask. So the goal of this, just to provide some security and some confidence with your contracting. So it is similar to our AgriEnhance in the sense that it is a band of protection. So an indemnity band of protection, it will be equal to the amount of the contract. So I'll illustrate that for you as well. Multiple contracts can be insured. Okay, so that's really important too. So if you want to get a little bit more aggressive on your contracting, as you are contracting, you can add more contracts. Okay, so that's possible. So take advantage of different pricing opportunities. I know there's, a lot of up and down right now with tariffs and all that kind of stuff and a lot of uncertainty, but absolutely, it's just a different perspective for taking advantage of different pricing opportunities. If I circle back to 2021 when we had, drought, like I'll just call it a drought year. So we had some yield volatility and then the prices skyrocketed. So there was quite a few contract buyouts that year. And that's essentially what we're trying to eliminate here, or help buffer, right? Is those types of situations and still give you the confidence to be able to, put some extra profit in your pocket with some more confidence. That's essentially the goal. So it's a very simple program. It'll protect again against yield shortfalls. So if you don't have those bushels there to fulfill the contract, and the futures price increase. So those two metrics need to be present in order for a claim position to happen. Because again, it's on a buyout, right? So that's how this works. So those two metrics need to be present: yield shortfall and a futures price increase. So as of right now, we're just utilizing the futures price. Okay, so we're not covering basis. Okay, so I'll make you aware of that. Okay, and the two crops that we are launching this on this year will be canola and hard red spring wheat. So those are the two commodities that'll be available to have coverage protection on. So I'll give just a real quick overview as to the simplicity that we are trying to make our platform. So basically, like if you were to go in, it's the same type of strategy for going in and looking at your AgriEnhance, like the crop to crop coverage, the crop insurance side. So you'll be able to also go into the Forward Protect platform as well through your online account. So very simple, you're just clicking on the Forward Protect. And so within that platform, you're just uploading some very basic information. So in this example here, we're showing a canola contract, the contract number, the company, that kind of thing, and the values. Okay, so we need some very basic details to start. And within your account, like I said, multiple contracts can be covered. So as you are contracting, you can continue to go into the platform and add multiple contracts and take a look at pricing. It doesn't mean that you need to take coverage on it, but you can absolutely take a look at pricing and see what that might cost you to cover off that contract. Okay. So again, very simplistic. Once the contracts are loaded, you'll come up to this little summary screen here as well, and you'll be able to see your pricing and the percent coverage, etc. Okay, so we wanted to make it very user-friendly. It doesn't mean you have to go in and upload all your information. We can also do that for you. So if you want to just submit direct to us, direct to myself, I can go in and upload all the details. Okay, so I'll jump into an example and give you that overview on, the concept of our Forward Protect product. So for very simple math, I'm using a 10,000 acre farm example just for math, but I get like this will apply to any size farm. Okay. So in this example, I'm going to utilize canola, 10,000 acres. We have that expected yield of 45 bushels. So again, that's like that 100% crop insurance. So expected production would be 450,000 bushels. Okay. And in this example that I'm going to be using, this producer already had contracted 225,000 bushels prior to this contract they're bringing forward. Okay. And so the contract that this farmer wants coverage on would be for 90,000 bushels, which equates to 9 bushels an acre. And his futures price is $15 a bushel. So the math on this, now we're determining, okay, so we have our 100% expected yield at 45 bushels. We're going to do a little bit of math here just to show where this band of coverage is going to sit. So where is our trigger point on this contract coverage? So we have an upper band calculation. So we're going to take the 90,000 bushels, so the contract that this farm wants to have covered, we're going to add to that the 225,000 bushels that they already had contracted, and then we're going to divide that by the full farm expected. So when we do that, we get a 70% number. So that means our top band trigger is going to be 70% of that 100% expected yield. Okay, so that's where this would be triggering at in a yield shortfall. Now the exhaust trigger, where does the coverage stop? So all we're doing is taking that already contracted, those already contracted bushels and dividing by the whole farm expected. And that gives us 50%. So now we have our exhaust trigger on the bottom. Okay, and that's where that band of coverage is going to lay. So again, 2 metrics have to happen here. We have to have a yield shortfall to put us into a claim position, and then we have to have that futures price go up as well to put us into a buyout. Okay. So if we were to take this example and go through the growing season, and this farm was to grow 20 bushels of canola, so that's their actual at the end of season, we can see that we're already in that full yield shortfall. So we're way past that band, okay? So the limit of liability on the policy is 1.35 million. We cover a max price change of 100%. Okay, so we're taking those 9 bushels an acre that's covered times the $15 a bushel times the 10,000 acres, and that's where we're getting the limit of liability for the policy. So the max payout for that policy. So the math on it's pretty simple. So we can see we have a full 11.5 bushel loss on the farm. And again, 9 bushels an acre is that max bushel coverage, okay? Up to that 100% price change. So if we were in a claim position now, so we know we actually grew those 20 bushels an acre. So our bushels are down. So we're in a production loss. If the price at the time of delivery ends up being $17, now that price is up $2 from what was originally contracted, we are in a claim position. So all we're doing now is taking that, because we maxed out the bushel loss, those 9 bushels times the $2 bushel increase times the acres. Okay, and that's where we're getting our claim payment from. So it's a very simplistic program. To sum it up here, So again, end of March here is our goal to be able to release pricing. So you'll be able to go in and take a look at that. If you have any contracts in place, you just want to take a look at pricing. And again, multiple contracts can be insured as I illustrated. There is a limited capacity program. So this is a pilot this year. So our deadline to apply for any coverage would be July 15th. And we're not tied to any grain buyers. So you can decide where you are going to be delivering your grain, okay? And who you're taking your contracts through. So with that too, when we're doing our claim position, we do not need a buyout invoice from the grain company that you are contracting with, okay? So our program is still separate from that. So even if you had some negotiations with the grain company and, for example, maybe it's a lower, buyout, right? That doesn't necessarily affect our coverage or our payout as well, because we're still going to be independent of that. So we're just utilizing the details of the contract. Okay, does that make sense? Anybody have questions?
So this program, a couple things. It's not predicated on having the other contract with you. This can be purchased separately. Is that correct?
Yeah, this can be purchased separate.
Got
Yeah.
nothing to do with that. So there's no timing. So that's nice and clean. In terms of the grower's individual performance versus, like, is it all individual premiums again, or it's just a static premium per crop?
No, it's still going to be individual premium. So like our Agri Enhance product as well. So we'll still have this all mapped out because we'll have the map of the farm, that kind of thing too. So it's still individually priced.
Okay.
Yeah.
Great. Any other questions, guys? Perfect. Well, once again, we can circle back.
Yep.
If need be.
Yep. So I'll just bring up our claims process because it is pretty simple. So again, just to recap, we're starting with that crop health check to see if there's any, issues in the field before harvest, that kind of thing, stored grain report. And then we would have our harvest report to determine if we're looking at a claim position or not. And if we are determining that there is a claim position, there will be some supplementary information as well. So your crop insurance harvest report is really good data for backup for the file too, a bin measurement. And if needed, this would be more an exception than the rule too, elevator or delivery summaries. It just depends when you start delivering and when that bin measurement would happen, etc. And so our payment settlements, I have before December here because that's when over 90% of our claims were paid out this past year. So we are very quick with claims. Our goal is just to kind of keep the farm moving and keep on going with your planning process and that kind of thing, prepaying for your inputs for the next year. So there's no hiccups with that. So it's a really good program to use for cash flow as well. On the Forward Protect side, very simplistic as well, just like the Agri Enhance. We're just looking for two metrics, right? So just determining, did the yield fall, right? So are we into that yield fall deficit, within that band, and did the futures price go up? So if once we're determining that, following that, the claims process is very similar to Agri Enhance, and it's quick as well. Okay, and if there's any other questions, feel free to ask now, or there's my contact information so you can reach out to me individually as well if you have anything further or think of something later.
Great. Well, thanks. That's very clear and concise, Tera. Just an open floor. Does anybody have any questions in their minds right now? And once again, just put up your hand or whatever. And if not, just shoot me a text if you want to do any secondary follow-ups and all that stuff. I'm just going to shut off our recording right now. So thanks for that, Tera. Really nice and clear and concise. And